Good afternoon. My name is Julianne Peterson, and welcome to tonight's Zoom at 8. Today is Tuesday. We meet here every Tuesday. I think that if you guys haven't met Chris Nebenzahl, he's going to be with us today, and I want to make sure that I give him as much time for your knowledge as possible. So Chris is the Editorial Director at Yardi Matrix and is responsible for overseeing market research and data analytics, as well as an editorial composition for Yardi Matrix, commercial property executive, and multi-housing news. Chris facilitates the expansion of the Yardi Matrix reporting suite and provides in-depth analytical tools for clients across the commercial real estate industry. His focus includes data analytics and reportings for the multifamily, office, self-storage, and industrial asset classes. Before joining Yardi, Chris served as a portfolio manager at the Bank of New York Mellon, managing fixed income portfolios for municipal and public sector clients across the United States. He holds a bachelor's degree in economics and a master's degree in finance, both at the University of Denver. So I would like to introduce you, and I am just so thrilled that he knows that this group is so helpful to his business, as well as he is so helpful to your business. Chris brings us the analytics of what's going on in COVID. So Chris, I'm just so thrilled you're here. And the little secret is that you're going to be coming back next week. Is that true?
It is. It is. As long as you'll have me, Julie.
Oh, we would have you every day of the week, Chris. You know, Chris and I spoke on a panel last week with the multifamily and more. If you missed it, I can get you the link. It was amazing. And so I really feel that the stuff that Chris is bringing to us is critical for moving forward in this COVID world, making decisions today that will affect your business tomorrow, next year, 2 years down the road. So Chris, please take it over. You are a rock star, and if you would share your screen, you are ready to roll. We are ready to listen. Oh, great. Yes, and tell me when you want to do that special thing we talked about, when we should launch it.
Yes, absolutely. So the special thing that Julie's talking about is loosely connected to what we're going to be talking about next week. And that's how I look at deals, how I find deals, how I use data to search for deals in new markets. So we'll have a poll going. I have 5 markets that I'm interested in right now. And I'd be curious to your feedback to hear what everyone on the call is interested in of these 5 markets. And next week, as Julie mentioned, I'll be back and we can do a deeper dive into one of the markets that we're going to talk about today. But first off, thanks again, Julie, for having me back. It's great to be back with you and with all of you tonight. Some of you may remember back in, I believe it was June, perhaps July, when I first came on the program, and we were talking a lot about how markets are doing, how the economy is doing. We talked about unemployment rates. We talked about sky-high jobless claims. We talked about stimulus checks and renter assistance and unemployment benefits. I'm going to focus mostly on the real estate aspect, but what I would urge you to do is really consider what's going on economically in your markets. Look at the jobless claim numbers, look at the job growth numbers, the recovery numbers, and look at the news. Just recently, we're hearing that some of the jobs that were initially furloughs, initially temporary layoffs, are becoming permanent layoffs. Disney is laying off 30,000 people from their parks. That's going to hurt Orlando and Orange County. United Airlines, American Airlines, are laying off, I think, a combined 32,000 people permanently. That's going to impact Chicago, Denver, San Francisco, DC, Dallas, Florida, some of the hubs where these airlines are based. So stay abreast of the headlines. Again, tonight we're going to talk mostly about the real estate data, but stay abreast of what's going on economically, because that will certainly have an impact on collections, on the ability to grow rents, and certainly on the ability for your deal to perform, whether you're looking to buy it, looking to dispose, or just continue the asset management. So with that, we'll go ahead and get started. And this presentation is going to be a little bit shorter than the one I gave, but we're really going to move more into a conversation between Julie and I, more of a back and forth on what some of the big trends that we're seeing. But I wanted to start off just showing where we're seeing the best rent growth. And not unsurprising, we're really seeing the best rent growth in tertiary markets. Tertiary markets, not all tertiary markets, but there are tertiary markets that, because of their economic base, their proximity to other larger secondary markets and primary markets, as well as their cost of living, have really put them in a favorable place to outperform during the COVID crisis and during the economic downturn. And so you look here on the left side, you see markets like Portland, Maine, Boise, Mobile, Chattanooga, Greensboro, North Carolina, Lexington, Huntsville, Columbia, South Carolina. These are all really good markets and mostly spread across the country. But what makes these markets unique is that they have very strong and diverse economies, very stable economies. You look at some of the markets on the right, and yeah, they have huge economies. They're the New Yorks and the San Franciscos of the world, the Bostons and the DCs. But they have incredibly high costs of living. And so what we're seeing, not only are people working from home and working from home for quite an extended period of time, and they're able to relocate. The tech companies in Silicon Valley really led this charge and said, you know what, no one has to be back until July of next year. So what a lot of people did in San Jose and Silicon Valley and San Francisco, they said, fantastic, I'll give up my year-long lease and I'll move to Boise. Boise's becoming kind of this next tech center. A lot of people are interested in Boise. There's a lot of development in Boise, a lot of growth in Boise. And people are moving out of California. They're moving out of Seattle. They're moving out of Denver, where I'm based, and choosing a market like Boise. Portland, Maine is a similar experience from Boston. You see Boston over here on the right, negative 2.2% rent growth on a trailing 6-month basis. That's really looking at March to September. And you contrast that with Portland, Maine, which is the fastest growing of our 130 markets over the past 6 months. So there's really this movement to tertiary markets. And I know a lot of you are invested in tertiary markets, looking at tertiary markets. And I would really encourage you to continue to look in those markets. Really where we're seeing the best growth, the strongest growth, and the ability to ride through the pandemic is in some of these tertiary markets.
Chris, can you explain to us, define tertiary and secondary markets for those folks that are here?
Certainly. So I guess I'll start with the primary markets. And the primary markets, in my view, and I know some people will look at it differently if you have a specific regional bent. I know brokers can look at it differently, and some property managers can look at it differently as well. But when I think of primary markets, I think of the gateway markets, the large coastal markets, and there are really 6 of those. It's Boston, New York, Washington, D.C., Chicago, San Francisco, and Los Angeles. Then you get into what I would call the secondary markets, and they're usually anywhere from 20 to 30, maybe 35 secondary markets that people refer to. And I would look at metros that have populations of 1 million to 1 million and up. So when I think of the secondary markets, I think of markets like Philadelphia on the East Coast, Richmond, Virginia, Orlando, Miami, coming across into the Texas markets. Houston, Dallas, Austin are all secondary markets. Denver is a secondary market. Seattle, Portland, San Diego are secondary markets. Minneapolis, Indianapolis, Columbus, Ohio, Pittsburgh. Those would all be secondary markets. And then the tertiary markets are metros and metropolitan areas that I would say loosely have 1 million people or less. And you see a lot of those markets over here on the left. Some of these might be secondary markets, some of these might be tertiary markets. But if you want kind of a loose definition, I would say around 1 million people in the metro, 1.5 million people in the metro might be the distinction there.
Thank you.
Sure. And Julie, that was actually a great segue, because I was going to say, if anyone has questions, please interrupt me. Please just jump in. I'm happy to stop. And like I said, as I'll do with Julie towards the end of the presentation, I'd like to keep it more conversational.
Perfect.
So going off of kind of the concept of what's a tertiary market, what's a secondary market, looking here at the occupancy numbers and the occupancy growth, again, you see really the secondary and the tertiary markets that have had the strongest occupancy growth. Nationwide, we've seen occupancy deteriorating, certainly large deterioration of occupancy. And this is just 6 months. So as we know, occupancy certainly moves slower than rents. So even a 1 percentage point change in occupancy is a pretty meaningful change, a half point change in Seattle and Boston. That's a really meaningful change across the whole market. But where do you see the occupancy growing? Again, at Albuquerque, New Mexico, Mobile, Las Vegas, which is an interesting one. Many of you might remember I was somewhat down on Las Vegas and pessimistic on Las Vegas, given how much of their economy is based on the tourism industry, is based on the conference industry, on the gaming industry. And many of those industries have really shuttered and closed down over the last 6 months, starting to reopen, but still struggling. But what's interesting about Las Vegas, and it speaks again to this migration pattern, and we'll talk about migration in just a second, but Las Vegas has become very, very attractive for people from Los Angeles and Southern California, saying, you know what, it's way too high, it's overcrowded, I can't take advantage of the amenities that LA has to offer if the beaches are closed down, if the restaurants are closed down. The benefits that I get from living in Southern California might not be there. But you know what? Las Vegas is pretty close, not a far drive, half of the cost of living, lower taxes. You know, I might relocate to Las Vegas. And so you're seeing an occupancy boost in Las Vegas. Again, the trend being secondary and tertiary markets picking up occupancy. Over here on the right side, San Francisco, the Bay Area, South Bay, San Jose, urban Chicago, Seattle, Boston, urban Philadelphia, the urban cores really losing population, losing occupancy as a result of, again, those benefits, the excitement, the amenities of a downtown urban core, the restaurants, the bars, the theater, the arts, the sports haven't been there. And to be honest, we don't know when those will come back. So I talked a little bit about domestic migration, and this data is actually from last year. We don't yet have this year's data. It takes about anywhere from 4 to 6 months for the Census Bureau to update this data. But look at last year's data and look at the markets that were doing the best. Phoenix, Dallas, Austin, Tampa, Las Vegas. These are markets where there was net in-migration, more people moving in than were moving out. On the flip side, Miami, Chicago, Los Angeles, New York, hundreds of thousands of people leaving these markets every year. And yeah, New York is a metro of 20 million people, so that's a small percentage. But overall, when we look at new housing stock being added, demand for new housing, these are concerning numbers in some of these gateway markets, some of these big markets, and really positive numbers in some of these more affordable secondary markets. And again, I said this is last year's data. We don't have the data, but all indications are showing that this trend is only going to continue, if not accelerate. I'm sure many of you have seen the New York Times articles, the Wall Street Journal articles, the USA Today articles saying Manhattan is not what it used to be. Downtown Chicago is not what it used to be. Downtown LA is not what it used to be. So while we don't yet have the data, I'm pretty confident that the data will back up this continued trend. And what we're seeing, especially, let's pick a market like New York. A lot of people are choosing to leave urban New York, downtown Manhattan, or the Brooklyn and Queens boroughs, And many of them are going to the suburbs. Many of them are going to live, if they have a second home, or go live with family. And some are saying, you know what, when the city gets back to being the city, I'll be back in the city. A lot of them, though, are saying, you know what, I'm used to the suburbs. I really like this. I like the ability to go for a walk in a park. I like the ability to have a little bit more space in my residence. And they won't go back to the city. And even a third portion is saying, you know what, why was I paying $4,000 in Manhattan or San Francisco or Boston or LA? I could take my job with me in many situations and go to Nashville or go to Raleigh, go to Denver, go to Dallas. And for even if I have to take a small pay cut, 10%, 15% pay cut that some companies are asking their employees to take, if you could take a 10 to 15% pay cut, but your living costs drop by 50%, well, it doesn't take a rocket scientist to figure out that that's a win-win for both you and your company. And so we're continuing to see more and more of this migration flow out of the high-cost cities, out of the high-tax cities, out of the highly regulated cities, and into some of these fast-growing secondary markets. Now, it's not every secondary and tertiary market. I'll show you the tertiary markets, some of the smaller markets here as well. Don't be fooled. It's not that every small market is doing well and every big market is doing poorly. There's certainly some winners and losers, as you can see here. Jacksonville, Boise, Greenville, Eugene, Spokane, markets in the Southeast, markets in the Northwest, equally doing quite well. Markets, smaller and tertiary markets in the Midwest and Mid-Atlantic, Northeast, many of those are losing domestic migrants. Bridgeport, Connecticut, Detroit, Baltimore, Cleveland. These markets are struggling. So again, don't take this as all small markets are doing well, all big markets are doing poorly. But the overall trend in where people are going is certainly to these smaller markets, more affordable markets, and better quality of life. You hear people often talk about the quality of life in the Southeast, in the Southwest, across much of kind of the smile of the U.S. that people call it, that pulls in the Southeast, across Texas, New Mexico, Arizona, into Southern California. The quality of life is not something to be overlooked. That works in with that balance of what's the cost of living, how's the economy doing, can I either A, take my job with me and continue to work, or perhaps could I find a new job in the market I'm relocating to, and how is my quality of life going to be? Many people are certainly considering quality of life, and if you're stuck in a 700 square foot studio, or perhaps even smaller, some of these big markets, trying to work from home, trying to live from home, trying to do everything in such a small location, a lot of people are continuing to move outward. So the last piece that I'll really tie up before kind of summarizing what we've been talking about and opening up to Julie for some questions is the development. Now, developers are not dummies. And in fact, they're quite smart and they're quite aware of what's going on with domestic migration, with rent growth. And so they keep a close eye and they move into markets very quickly. We talked about Denver. We talked about Austin as markets where people might leave the coastal gateways because of the quality of life and the cost of living. Dallas and Phoenix, other markets where you see people migrating to. Well, at the same time, there is a lot of new supply coming online. Now, I know many of us are probably not playing in the brand new space, the Class A plus space. But what I would urge you to do is think about the trickle-down effect. Like I said, I'm in Denver. We're adding something like 17,000 units next year. I think we've built about 10,000 units already this year. We still have a quarter to go. Many of those, if not all of those, will be at the high end, but that does have an impact all the way down as people move into the market. It drives up the price to an extent, the new development. It helps sometimes drag up rents at the B and C class. But oftentimes it does a glut of supply, like what we're seeing in Denver or Miami or Austin, will have kind of unsettling movements on a market where you might not be able to get the exact rent growth that you underwrote. You might not be able to see the exact performance. Overall, I think development is a good thing. It's certainly evidence that the markets are moving forward. But again, if you're looking at specific deals and specific deals around new development, I would be cautious because that new development likely will have some unsettling effects on your numbers. On the flip side, you can look at some of these markets that have really low development. A market that pops out are Mobile and Huntsville. 202 units expected to be delivered next year in Mobile, 218 in Huntsville. To me, that sounds like one development deal, maybe two smaller development deals. Given what we know about the migration and the outperformance in some of these markets, as well as limited new development, that might be a good combination in order to say, you know what, I might be a little bit hotter on one of these markets. Tucson is another one where we've seen pretty good pretty good occupancy growth, little development, pretty good demand in the Tucson area. Might be a market worth checking out. So with that, I'll just kind of summarize and wrap up. I think it's about 8:40 on the East Coast, 5:40 on the West Coast. So we'll have about 20 minutes. But just to summarize, as I said, COVID-19 had major impacts on the gateway markets. The biggest rent declines were in the gateway cities. The biggest occupancy declines have been in the gateway cities. People are looking for more dense submarkets if they want to stay in the metro. And a lot of people are saying, you know what? It's been too expensive for too long and it's too crowded. It's time for me to try another market. Try perhaps a market with less density, less commotion, less traffic, and certainly less cost of living expense. The real estate recovery is strongest in tertiary markets, as I've been saying. Outperformance, limited supply growth, and really strong occupancy growth. Also really good domestic migration. Development has continued through the pandemic. Perhaps when I last spoke to this group, I was saying that we expected really a sharp decline in development, and we're not seeing that. We did see a number of markets were forced to pause development in March and April, perhaps in May, but the development has come roaring back. The construction industry has come roaring back, and that's not just multifamily, that's commercial, that's storage, that's industrial. The developers are really moving ahead. And one interesting thing that we've seen, and Julie referenced, she and I were on a panel about a week ago talking about interest rates, and Julie, perhaps you could go into more detail. But right after the COVID crisis began, the 10-year, kind of the benchmark rate for lending, fell quite quickly. The Fed, as we know, dropped the short-term interest rates to zero. But for a while, the multifamily borrowing costs had not really moved. There were some new reserve requirements. There were different requirements that the agencies were putting into place. So the borrowing costs didn't get much better. But what we've seen over the last, I'd say, 2 to 3 months is the cost of debt has really come down. And in a way, what the Fed was doing, what the fiscal stimulus was doing, was trying to backstop asset values, backstop single-family home values, backstop multifamily values, backstop the stock market. We saw the stock market really plummet in March and April, but has come back for the most part since then. It's been volatile for the past, I'd say, month or two, but for the most part, the stock market is back to somewhat of a pre-pandemic level. So all this stimulus really helped backstop values. And what it did in multifamily is that as the performance fundamentals dropped, the rents dropped in San Francisco and New York, the occupancies dropped, but the drop in interest rates allowed those valuations to really stay the same, because even with lower net operating income, owners could refinance or buyers could come in with lower net operating income if they had lower debt, they could still afford the same value. Interestingly enough, though, in some of these other markets where fundamentals really rode through, think about a Portland, Maine, a Huntsville, a Chattanooga, where we've seen rent growth. Now we've got the same interest rates falling. Owners can come in, finance at lower levels. We can refinance at lower levels if we already own, and continue to see that outsized performance. And as a result, valuations in some of these secondary markets and tertiary markets really went up. So quite a surprising, I'd say, turn of events. The low interest rates, and I expect them to be lower again. Julie, you know a lot more about this subject than I do, but I expect them to stay low for quite a while. That's really going to help keep valuations where they're at, or perhaps increase valuations. Now, I will say on the flip side, many of us were hoping and looking for distressed assets in good markets. I don't know that we're going to see that. Again, because of the interest rates being so low, operating fundamentals haven't declined as much as we thought. The collections are a little bit weaker than they were last year on the national scale, but again, not tremendously terrible. So the combination of those lower interest rates keeping values high, fundamentals staying a little bit better than we had expected. I don't anticipate a whole lot of fire sales. I don't anticipate a whole lot of distressed selling. And so I would say, continue on with your strategy and let's keep plugging forward through the fourth quarter and into 2021. So with that, Julie, I'll turn it back to you, and perhaps we can just kind of talk about what's on our mind and certainly what you're seeing in the interest rate market. I'd be very interested in seeing.
Sounds great. Let's open this up to everybody. Hopefully that made some sense to you. One of the questions that I have, and I've heard some of the gurus talk about, we're going into these smaller tertiary markets, and can we really stay away? Can we miss out on the good food and all of the plays and the, having Costco right around the corner and all of the, if I'm thinking of New York, there are people that want to live there. Is this only going to be a temporary, and then we're going to see the shift? I think that's one of the concerns that people have currently. How long is that going to stay? What is your thought on that?
Yeah, that's a good point, Julie. And a lot of the urban core is quite attractive to two age groups. It's young people in today's situation, the millennials and some of the older Gen Zs who perhaps don't have families or just out of college, working a first job, want to be in and around that scene, want to be at the cool restaurants, the cool bars, the sporting events, the plays, as you mentioned. And then on the flip side, it's empty nesters. Think of baby boomers who are saying, you know what, I don't need this big 4 or 5 bedroom house in the suburbs, but gosh, my favorite restaurant is right downtown on Main and Main. And hey, there's a brand new apartment building right there. What I think you'll see over the course of COVID and the recovery, the longer things stay closed, especially in the urban core, downtown San Francisco, downtown New York, downtown LA, the millennials, the younger people are going to say, you know what, I do like those restaurants and I do like those bars, but I can't take advantage of those right now. And I also love skiing or hiking or mountain biking. And you know what? My best friend from college just moved to Austin, or, my girlfriend's brother just moved to Boise. You know what? Why don't I try that out? And they're coming to realize that Austin has a great music scene. Denver has a great brewery scene. You don't just have to be in these big markets to experience kind of the amenities of the big markets. And then on the flip side with the baby boomers, I think many of them chose to get out of the city if they could, if they had a second home, if they had family, what have you. And I think many of them will say, do I want to go back to that market if I own? The real estate taxes are incredibly high. If I rent, the cost of living is incredibly high. Maybe I can afford it, but maybe I also want to be a little bit closer to my kids who just fled San Francisco, Boston, and New York for Austin, Dallas, Denver, Boise, Charlotte. I think you'll see more and more of that trend the longer the COVID-related shutdowns, and they're not shutdowns, but the closures of the arts and the culture and the restaurants, the longer those go on, I think the more likely you'll see permanent relocations outside of these big markets.
Okay. I've got some questions, so I want to bring those up, and we'll go through the questions and then we'll open it up to everybody else who hasn't posted here. So why do you think development has continued to be so strong through the pandemic?
Yeah, so going into 2020, we were still in a housing shortage. We had been developing more and more multifamily units over the second half of the last decade, the second half of the real estate expansion. But on an aggregate scale, we were still in a housing shortage. And I don't have the data right in front of me, but if you think back to 2004, 2005, 2006, going into the great financial crisis, we were building somewhere between 1.6 and 1.8 million housing units a year. Now that combines multifamily and single family. We were building about 1.3, 1.4 million single family homes and about 300,000 to 500,000 multifamily units in a given year. Now we certainly know what happened in 07, 08. We had overbuilt, we had overlevered, and the great financial crisis kind of brought that all to a crashing halt. But in 09, in 2010, in 2013, 2011 and 2012 as well, not to jump ahead to 2013, but we were slowly recovering. We were building about 100,000 to 150,000 apartment units. We were building about 500,000 to 700,000 single family units. So on aggregate, we were building about 1 million units a year. And household formations, they weren't as high as we were building in 2005. Household formations have always been around 1.2 to 1.4 million. So we were overbuilding in 05, 06, 07. We were underbuilding in 09, 10, 11, 12. The multifamily side finally got back to 250, 300, 325,000 units a year. But the single family home building never really recovered. It never got above 1 million units, really through the whole recovery. So overall, and again, this is kind of the national picture. Market to market is going to be a little bit different. Some markets were overbuilt, some markets were drastically underbuilt. But across the nation, looking at household formation, looking at new housing development, there was still an undersupply, a backlog of demand. And so that really hasn't changed. Again, thinking about distress, thinking about what we were envisioning back in April and May, when we said, look, occupancies are going to plummet. People are unfortunately going to be evicted. People are going to lose their homes. People are going to get foreclosed on. We haven't really seen that. So we haven't seen the loss in demand for housing. And I think the developers are somewhat optimistic, whether it's through continued fiscal stimulus, overall economic growth that will allow people to continue to pay their rent, continue to pay their mortgage. The developers have said, look, we're not seeing that deterioration in fundamentals. We're not seeing that deterioration in occupancy, that housing displacement that we've seen in past crashes. So you know what, we're going to continue to build. We've got demand. And again, the building, especially on the multifamily side, is starting to shift a little bit when you look at some of the planned developments, not necessarily what's under construction today, but looking at the planned developments, it's going more suburban and it's going more towards these secondary and tertiary markets.
Wow. There's a question about the long-term impact on the low rates, and I can identify with that. As you've heard, the feds have said that they're not going to be raising this for another 3 years, and it will potentially impact inflation. But if what we're trying to do is get the unemployment down. Right now we're at 1% inflation, and if we can keep it at less than 2, I think we'll be okay. That would be the interest of keeping it low, so that we're not elevating that inflation. It could, that is the bad thing about if we keep these too low, or if they go high quickly, that could very much impact all of us. So Chris, what is the best looking Midwest markets now, if any? Lumber prices were slowing down. Building in Michigan, many builders have stopped building. Extra costs of $16,000 per door or per home, and around $5,000 to $6,000 per unit on condos and apartment. Lumber yards are saying no relief, and I'm after the end of the year.
Yeah, and we have heard that the cost of goods has certainly increased. That was a pre-COVID and a pre-pandemic concern, and it continues to be. I think back to the first question, what markets do I like in the Midwest right now? Indianapolis is a market that continues to kind of pique my interest. Look at what Salesforce has done in Indianapolis, and they've almost said, look, we're going to start this trend of expanding outside of the gateway markets. Certainly they have a huge presence in San Francisco. They have their headquarters in San Francisco, but they recently opened a Salesforce tower in Indianapolis. They have a huge employment base in Indianapolis. They're getting into Denver with another, really large expansion. So what I like about Indianapolis, certainly it's got a very talented workforce. You look at the universities that are right there in Indianapolis, as well as some of the surrounding universities in Indiana, as well as kind of the tech infrastructure and the tech talent in Indianapolis. I like that market a lot. Similar things could be said about Columbus, Ohio. I like Columbus, Ohio a lot. A little bit more than Cleveland and a little bit more than Cincinnati. I think one of the trends that you're seeing in the Midwest, well, I'd say it's a two-part trend. A lot of people are either migrating from smaller towns to the big cities or the close-in suburbs of these cities like Columbus, or they're moving out of the state and out of the region completely. Here in Denver, it looks like every car you drive past is an Illinois plate, an Ohio plate, a Wisconsin plate, a Minnesota plate, with people moving westward. So I think you see a lot of out-migration, but also a lot of concentration, again, in the city. These cities are a little bit less dense, certainly than the coastal gateways, and in the inner ring suburbs of some of these markets. So Columbus I like a lot. Indianapolis I like a lot. Minneapolis is another market I like a lot. Really strong fundamentals in Indianapolis. Indianapolis has always been kind of a 96, 97, 98% occupancy market, well above the national average of kind of 94, 95. Not the best rent growth, but again, pretty strong and stable operating fundamentals in Minneapolis.
I think that it would be a good time to do the poll now. What do you think?
Yes, go ahead, Julie.
We do not want to miss out on anybody having to leave. So let's see. I want you to see out on your video, on your screen there. We're looking to find out your secondary and tertiary markets. If you could choose one of those, and we will break it down next week, which is the most popular, so that you can make some decisions on these tertiary markets. So what your choice is Boise, South Bend, Indiana, Portland, Maine, Chattanooga, Tennessee, or Greensboro, North Carolina. So I want to make sure that we've got 30 votes in. Keep your voting in. We're soon going to be going to the election, so you can practice right now. Casey, did you put your vote in? Casey, did you vote? I hope so. Your vote is important.
I just voting now.
Excellent. I know you were taking some time to think about it. This is important stuff here, you guys, because I want Chris to come back, and we're going to come back next week and produce some really good information on these markets. So while you might not be living in these markets, you may be meeting somebody here who lives in this market and can be your boots on the ground. Really critical in finding your teammates. So we're going to go, we've got, I see 5 more people who are really taking this in and making a choice. What is your choice going to be? Boy, this is fun.
Chris, as an Alabamian, I appreciate you saying Mobile with the correct enunciation. Most people look at it and say Mobile, Alabama. So
crazy.
What? A quick question. Any leading indicators that you look at in any of these markets, that you really like to really kind of firm up how much you appreciate that market?
Yeah, certainly I would look at job growth and what type of job growth is going in. Down in Alabama, Huntsville is an interesting one where it has a pretty unique economic base, a pretty unique job market compared to other markets really across the South. A lot of high-end jobs, aerospace jobs, engineering jobs. If you're a Class A investor or even a Class B investor, you want to go where those high income jobs are at. You might not be targeting your property if you're a Class B or a Class C investor, but what those jobs bring is a lot of other jobs to support those jobs around it. So oftentimes you'll see the schools, the government, logistics, manufacturing pop up around those job centers that have a lot of kind of high-end, high-paying jobs. So even if your ideal tenant is not, the engineer making $150,000, what that job or that individual will bring to the market will add a lot more, I'd say, economic diversity to the market, and therefore kind of help across the apartment spectrum, A+ down to workforce housing. Excuse me.
Thank you.
Hey, Julie.
Commentary.
Yes.
This is Andy.
Hey, Andy.
You always try to block me or kick me off, so I'm sorry if I asked this question already, if this was asked. Did you ask about Prop 21, our beautiful California invention that could be in all of the blue states? Do you have any comment on that, Chris?
Yeah, and speaking of Prop 21 specifically, but it's not just Prop 21 in California, Andy, as you mentioned. There is a lot of real estate and housing regulation being discussed, whether it's going to be on a ballot this year, whether it's going to be on a ballot next year or in 2 years. Without getting political, a lot of these regulations are moving to make it more restrictive for housing owners, for housing operators, whether it's rent control, whether it's increasing property taxes, whether it's foreclosure evictions, for-cause foreclosure evictions, eviction moratoriums, not foreclosure evictions. There are a number of what I would say concerning regulations being discussed. And if you're playing in a market like San Francisco, like LA, like San Diego, like Seattle, like New York, like Chicago, Cook County, and taxes, and anyone invested in Cook County or live in Cook County,
That's where I'm from.
That's a big concern. And I think if we were to poll the group, I would imagine a lot of you are invested across the Southeast, Midwest. Those markets tend not to have the regulatory restriction. But again, without getting personally political, there are factors pressing on some of these markets that will make it harder for the real estate community to continue to operate.
All right. We are at the end of our time. I usually like to stay on time to get in and get out. So I encourage you to be here on time, and I will be respectful for you guys to get out on time. So, couple things. Chris, how do we get a hold of you?
Yes, I can put my contact information in the chat. It's probably the easiest to do that because my name and email is a bit of a mouthful.
Okay, so you do that. You concentrate there. I'm going to keep going. We had a great totals. You guys did great on doing the polls. We've never done that, and now you are pros at it. We have North Carolina, Greensboro, North Carolina, Chris, is what we're going to be doing next week. Now listen, Chris is amazing, as you have experienced, but what I want to make sure that you understand is that you need to be cognizant of these markets. This is not open up, you know, an encyclopedia. This is not doing Googling. You really need to go to the experts to get this information. You're taking millions of dollars from people. So you want to be the expert, and you need to reach out to people like Chris, who can help you understand the market. Where are you going? What can I think about? What are the things that I need to be concerned about? What are we doing looking forward? So Chris has been amazing to help out our clients to make sure that you are providing accurate and excellent, non-biased information. Remember who you are going after when you're looking on these Google searches. What is the crime? Well, does the city really want to talk to you about the crime? So it's important that you look at the right information, the right data analytics, and Chris, working with Yardi Matrix, is the type of quality information that you need to have. So without anything else, so that's all I have for you guys today. I appreciate your time. I appreciate that you make this a consistent visit with us every week. Make sure you tell a friend, and let's build this thing for something really special that it is. Without further ado, I will say goodnight. Thanks so much. Have a good one.
You're the best, Julie.
Thanks, everybody.
Thank you.